Hey everyone, Jonathan Wu here from SW Online Invest with our July 2024 updates. If we start with China, for the calendar year 2024, China should be able to achieve its 5% GDP growth rate. One of the biggest issues that's facing the Chinese economy is effectively the lack of confidence in the overall market, which has primarily been driven by the property slowdown that's occurred over the last 2 to 3 years. One of the things we have seen the government do, though, is that it's recently started using the term destocking of property inventory for the first time since 2016, which is effectively asking SOEs to buy up existing property inventory and repurpose it either as affordable housing or selling at a loss to consumers and therefore helping create a floor to the price. If prices find a new floor, you will then see confidence coming back to the market with property prices coming back up, transaction levels going back up, but then at the same time, you will also see consumer spending pick up, which is no different to any other country. So this is something that we've been monitoring quite closely. In India, what we've recently seen is that Modi has been re-elected as Prime Minister. But the biggest issue this time round compared to his previous elections is that he did not outright win with his party, the BJP. Prior to the election, he was holding, and the BJP was holding about 310 seats, with 250 seats required for an outright majority. This time around, they only scored 240 seats and had to form a coalition, which has gotten them to about 290 seats. This creates an issue from Modi's perspective in terms of political will, because a lot of the successes that Modi has had is based on the fact that he's had an outright majority, which previous to him forming government years ago was not the case, which created a lot of red tape issues within India. Where Modi actually lost a lot of his seats in this election was actually in many of the eastern states, which is around Muslim communities, because there has been a lot of rhetoric and his policy stance has been quite anti-Muslim since he got into power. Furthermore, from an investment standpoint, one of the biggest issues that we see is that valuations are very stretched. When Modi got into power originally, the Indian share market was trading around 14 times PE. Just prior to the election, it was 18 times, and now post-election, interestingly enough, it's now over 20 times, in which we currently think the headwinds are actually quite strong, and therefore has led us to remain underweight for India across our portfolios. Back home, Australia's inflation figure still remains stubbornly high at around 4%, which is hamstringing the RBA's ability to cut rates. And in actual fact, market pundits are expecting that in August or September this year, there could actually be a rate rise. One of the fundamental problems with the inflation that we've observed is that over 90% of the inflation in Australia over the last 12 months or so has been largely attributed to inelastic spending, i.e. things like fuel costs, school fees, and food, which are effectively non-negotiable items that no matter what the cost is, you effectively spend. To make matters worse, things like insurance premiums on average across different forms of household insurance have gone up at an average rate of 28% in the last 12 months, which has led to now effectively 1 in 8 households struggling to actually afford to keep up with insurance. Furthermore, if we look at it from a GDP growth perspective, this has now come to a head with even the federal government conceding that growth is actually weak. And if it wasn't for actual net immigration into the country, which has been very strong in the post-COVID environment, GDP growth is actually going backwards. And finally, one of the things that we're also seeing is that from an investment standpoint, large cap Aussie equities is actually seeing valuations quite stretched, which is then feeding into our asset allocation objectives for the portfolios. Two key points that are coming out of the US economy is that inflation is coming down. And one of the things is that if our situation locally in Australia sees inflation staying stubbornly high, but the US inflation come down, leading them cutting rates, it's actually not a bad thing for Australia, because Australia will then have a marginally closer interest rate environment to the US, which will draw more capital onshore. Furthermore, one of the biggest risks we see on the horizon is post the most recent US presidential debate between Biden and Trump. It is highly likely, or getting more and more likely, that Trump will actually win the November election. This will be highly inflationary for the world, which will cause other impacts to globalization. Because if we follow Donald Trump's original strategy from 2016, it was all around deglobalization and the MAGA movement, which basically onshored a lot of the manufacturing back into the US, which will lead to further inflation that we've been trying to keep under control since COVID. Europe as an investable destination for us continues to be a struggle. One of the key issues is that a lot of the major economies are going through elections, and at the time of filming, the UK election just finished, and after 14 years of the Conservative Party, the British population has very loudly responded and basically delivered a landslide victory to Labour and its new Prime Minister, Sir Keir Starmer. Furthermore, France has also just had its election, and we've also seen that economy swing further to the left. Whereas in other major developed economies in Europe, including Italy and Germany, they are actually starting to float further to the right. Furthermore, we still have conflicts in the Middle East, as well as Ukraine and Russia, which causes a lot of uncertainty, and the lack of transparency overall in the direction of those economies, hamstrung by effectively democracies, doesn't give us confidence to invest in that region for the time being. From an asset class perspective, one of the up and coming, or very much in vogue, asset classes for investors to consider has been private credit. And private credit is obviously a very broad church of investment opportunities that is effectively deriving income from alternative sources that doesn't come from bonds or term deposits or cash. Now, these are obviously attracting quite attractive rates of interest, anywhere from 7% all the way through to mid-teens. Now, because this is a broad church and because of the simple plethora of investment options in the private credit space, the investment committee has recognized that given the rise and popularity of this asset class, that we do have to proceed with more caution than we did 2 years ago, because in many cases, we're finding the risk and return opportunity for investors are certainly not quite right. And as an investment committee and as investors ourselves invested in our own portfolios, some investment opportunities we are definitely skipping because they don't make sense to us on a rational investor basis. Turning to portfolios, if we look at the Asian All Stars portfolio, you will note that it has registered quite strong performance over the last 6 and 12 months. In compared to the other portfolios, one of the biggest drags though has been the overallocation or the overweight towards direct China equities, which has been hamstrung from an economic perspective due to lack of confidence. Earlier in the year, we have seen that confidence picked up after the government announced a few measures, and we saw the market rally quite strongly from the end of March through to around the end of May, but since has dropped off somewhat due to some of the policy response hasn't been followed up as strongly. At the end of the day, with regards to our overweight in Chinese equities, we believe that we are probably in a bit too early, but overall, as policy stance continues to be more loosened and more aggressive, we believe that the property market will find a floor, therefore underpinning the next wave of growth, which will start from consumer confidence, buying more property once again, and then therefore also consuming more. So the investment committee has decided that at this point in time, the Asian All Stars portfolio will remain as is, and we're very comfortable with its positioning.